Tom Lee has dropped some very important information on the stock market. You're going to want to strap in and listen to this. Don't worry about subscribing, smashing the like button, or looking for the Discord and coaching link. We will talk about that very soon. But first, I want to strap in and start touching base on all the things Tom Lee just discussed, as they're super important. Let's go.
Tom Lee joins us this morning, Fundstrat Global Advisors, head of research and a CNBC contributor. Tom, great to have you.
Good morning.
Happy Thanksgiving in advance.
Thank you.
Write about some clearing events that we've gotten through, right?
Yes.
One is clearly best into Treasury, and then NVIDIA's earnings, too, kind of remove some uncertainty?
Yes, and we could tell the market was sort of holding their breath on both, because once NVIDIA reported, the markets began to levitate. And, of course, we're seeing the market reaction today to Treasury Secretary. These are all both good events, but also showing you there's been a lot of cash on the sidelines, which is why we're rallying.
Right.
Yeah.
Although making a pretty good yield, I imagine. What's the impetus to leave those sidelines if rates can hold these levels overall?
Well, I think one thing we have to keep in mind is there's $7 trillion of cash on the sidelines, which I think in general portfolios are overweighted and risk-free. And I don't know if it's going to be 5% 2 years from now. So I think investors, as they're planning ahead and they're seeing an economy that's resilient, I think the case for equities is still very strong right now.
Have you done any work on earnings for next year or the year after?
We're actually working on it now. Our outlook comes out December 12th.
All right. So we'll check back with you then.
Yeah.
Meanwhile, what sectors do you favor at this point?
Well, I think the template that we think makes sense is buy things that either benefit from a dovish Fed or a Trump White House, which is small caps, cyclicals like the financials, the regional banks and industrials, and of course crypto, especially Bitcoin and some of the proxies like MicroStrategy and Semler Scientific.
But did you hear what we were just talking about? Can the Trump administration get away with the pro-growth policies and a dovish Fed at the same time? Because some of them work against the Fed being able to cut rates.
Yeah. I mean, I'd say the market is very skeptical at the moment. That's what we're hearing from our clients. But that also means that's room for positive surprise. And I think one thing to be mindful of is the Fed can be dovish even if there's resilient growth, as long as inflationary pressures and expectations remain intact. And so far, that's been the case.
Has it, though? We're seeing a little bit firmer core readings on inflation, and I guess it depends on what he does with tariffs. Yeah,
but if you look at survey expectations, whether the Federal Reserve Survey or UMich, we're seeing 5, even 6-year lows on inflation expectations. So we're back to pre-pandemic levels from what consumers see. And then if oil falls, as you know, that sort of pushes down the inflation forward curve.
On the 1-year expectations, right?
Yeah.
Fives have not been as well behaved.
That's right. And, those surveys are notoriously a little funky, because if you look at the range of answers and the actual data, some people put 1,000% as the survey answer. So they can tend to skew the actual medians.
Right. Meantime, there is this school of thought that commodities are not suggesting rampant inflation or a return to a double-top CPI. You got Europe increasingly exporting disinflationary narratives, certainly China.
Yes,
right?
That's right. And I think there are many people who thought inflation would pick up because of tariffs. But as you know, it's not clear really what ends up being implemented. And if we get milder tariffs, that's actually less inflationary pressures.
Page 1 of the Times over the weekend was about companies elbowing each other to get in front of the president-elect to make their case to be carved out of tariffs.
Yes.
And then this morning, Reuters has a piece on the farm industry, again, looking to be exempted from deportationary efforts. How much policy risk do you think is going to be embedded in the next year, at least?
Well, I think this is what investors are concerned about, because we know that there was a campaign that was run on tariffs and deportations, but as you know, those can be very harmful to the economy. So I think that having the right cabinet picks can actually get us into sort of the right blend of sort of outcomes. And I think that's what the market's starting to price in.
Meaning you've been impressed with the picks so far?
Yes, I think not only have I been impressed, but we can tell from our client feedback that the markets really like this.
So you heard what Tom Lee had to say, and I said the same thing last week before NVIDIA earnings. When NVIDIA has earnings, usually the week leading up, the stock market is kind of hesitant or kind of consolidating, and to some degree slightly bearish, because everyone's holding their breath. Investors, institutions, holding their breath on NVIDIA because, let's face it, they have a $3 trillion market cap. And when a company like that, especially in the AI sector, is reporting earnings, you don't want to have a frenzy of buying and then they miss on earnings and then the stock stocks start sliding. That's basically what Tom Lee was saying. And then after NVIDIA earnings, the market started moving again. But he talked a lot about the market and the expectations and inflation. So I want to touch base on these things. First thing to talk about is when Tom Lee mentioned money on the sidelines. And what he's talking about is money markets, like a money market cash yield, like the SPAX, SPAXX, or the FDIC cash sweep. And because they go hand in hand, high interest rates, it's better to put money in a money market than the stock market. It makes investing harder and the market doesn't soar as high. It actually starts to level off. Volatility goes up and the market pulls back because there's a lot of money in the sidelines. And what he's saying by money in the sidelines, he's basically saying money in a money market account. Now, I'm going to break this down for you. Would you want to trade in the stock market if you had big money, like $1 million, $2 million, $3 million, and make 1% to 3% per month, or just make 5% annually and do nothing and have no risk? Now, that may sound like a trick question, but it's not. If you're a big institution and you have $10 million, then you times that by 5%, that's going to give you $500,000 a year. Doesn't sound like a lot of money, right? But it's pretty good considering it's like $1,500 a day and basically free money. So when you're a big investor and you've got $10 million, or maybe even more than that, because a lot of these guys have way more than $10 million, but some of the smaller fish have $1 to $10 million, including myself. So if you have that kind of money, then you're looking at making upwards of $1,000, $1,500, even $2,000 per day. We're talking like a lot of money. We're talking $20,000 to $40,000 a month in interest. Why would you even bother trading and taking a risk when there's a lot of inflation or the markets are down? Now, this is part of the reason why the markets have been down from 22 until this past year. In 2022, a lot of money was moved out of the stock market into the sidelines. Money market accounts, SPAXX, FDIC insured cash sweep programs. And this is to mitigate a lot of risk. And Tom Lee said he was very bullish on equities. And this is what's actually gone on. The reason why the bull rally, we call it a bull rally in the market right now, keeps going up and it hasn't slowed down is because it's actually not really a rally. This isn't like an earnings call that went bad and then good news came out and people are buying into it. I think you really have to understand what's going on with the sidelines, the money, cash sweeping, whether it's FDIC insured or government mutual fund, which is the SPACs, which is really where there's $7 trillion, Tom Lee said. And as soon as interest rates start getting cut, it doesn't seem as valuable to leave your money over there. If it's 6% or even 5%, it's good. 4.5% is still pretty good. 4.26%, where it's at now, is still pretty good as well. But once it drops to 4 and 3.75 and then 3.5, once we get to about 3.5, there is going to be an influx into the stock market. A lot of big time investors, when they start seeing 3.5% or 3.25 or 3, that money is all coming into the stock market. We've only seen a very small portion. I'm not sure exactly how much, but I'm willing to bet that it's a rather small portion compared to the $7 trillion. Like, I would probably estimate somewhere, it'd be hard to say, but just to give you guys some number to go off of, maybe 20%, 15%, something like that. There's a lot of room to grow. And the feds are dovish and they're going to be cutting interest rates yet again in 2025. I think the going rate for 2025 is 50 to 75 basis points. If that happens, we're going to be looking at a 3.5% interest rate by this time next year. So 2025 is going to be very transitional and bullish because of expectations. Which segues me into the next part of what Tom Lee said, is that based on surveys, the 5 to 6 year expectations for inflation on the consumer side of things, how the consumer views inflation, is low. And according to the reports, the consumer's expectations and views of inflation is basically at pre-pandemic levels. He also explained that oil is likely to drop with Trump in office, which I agree. Oil is likely to drop. And when crude oil drops on the 1 year yield curve, it pushes inflation expectations down drastically. Also, Europe and China have a disinflationary narrative with their exports, which further explains why things are moving in the direction that they are. Now, the market is skeptical due to tariffs, Donald Trump's policies, drilling, and different stock sectors, and overall sentiment is somewhat skeptical, even though money is coming in from the sidelines into the stock market and moving it up. But skeptical is okay because it leaves room for surprise. So when we're skeptical about tariffs and then Donald Trump announces tariffs, say in February, as an example, that they're going to be lower than we expected, well, then the stock market shoots up. Is a good thing for the stock market. And we also have to look at something else Tom Lee said, which I agree with 100%, I'm telling you, and that's the stocks that are pretty strong in the market are going to be cyclical, especially the financial sector and small caps and industrial. Johnson & Johnson, Caterpillar, Wells Fargo, Citibank, PayPal, Block Square, Bank of America, Ally Financial. These are all going to be very good stocks. SoFi, Palantir, Snowflake, Oracle. These are all great stocks. Apple, AMD, NVIDIA. These are stocks that are going to grow and hold strong through 2025. Bitcoin, Dogecoin, SHIB, these are all going to go up as well. Ethereum, based on Donald Trump, anything in the financial sector, including crypto, is going to go up. Me personally, I love Ally, Citibank, Wells Fargo, Bank of America, Ally. I like Verizon and T-Mobile pretty decently as well. Coca-Cola, Kraft Heinz, very strong. Palantir, like I said, SoFi is also really good. SoundHound, AMD, NVIDIA, all very good stocks. Meta and Microsoft are also good. Netflix is too. But really, honestly, if I'm sitting here explaining to you guys the stocks that are going to explode and the stocks that I would want my money into, I would look at those financial stocks that I just told you. SoFi, Palantir, SoundHound, and also American Superconductor is also very good. And Johnson & Johnson. Then we also have Caterpillar and we have JB Hunt. We have a lot of these cyclical. Procter & Gamble. We have Colgate, Palmolive. These are just off the top of my head. There's some of these really good cyclical stocks. Kraft & Heinz, Coca-Cola. These are all really good stocks to get into this year. And small caps. There are a lot of small caps that are projected to do pretty well. And I have videos coming up on these stocks that I think are going to do well for you. I also think that Walmart, Target, TJ Maxx, Wayfair, especially Wayfair, as well as Synchrony Financial are another set of stocks that are really good for 2025. But like I said, I have got a top 5 stocks to buy before 2025 and top 5 stocks for December of 2024 coming out in the next week. So stay tuned for that. Look, if all of this talk about stocks, cyclical stocks, market sentiment news, if all this stuff confuses you, look, it confused me in the beginning years and years ago when I started. I can understand how frustrating it could be. Maybe you want to grow your portfolio, retire early. Maybe you just want to build up for your retirement later on down the road. You're having a tough time. I have a full training course, Discord, and offer one-on-one coaching to help guide you and get you up to speed so that you can have the financial freedom that you ultimately deserve. And I would love to help you. I grew up in a Catholic household. My parents were very hard on me to help others and do the right thing when possible. Nobody's perfect, but I've always tried to help people the best I could. And when I hit rock bottom 7 years ago and told myself that I wanted to achieve financial freedom and I set out to do that, once I achieved it, I told myself that I would help others the best I could, and I created a system to do just that. You guys can see the profits on the screen. I've helped students with small accounts of $8,000 turn into $30,000 in 4 months. Other students have went from $30,000 to $80,000 in 3 to 4 months, and I have students that even doubled their portfolio from $300K to $600K in 5 months. If you guys would like to take control of your financial freedom, you can do so at any time. InvestWithCorey.com. Links in the information box below. Just go to the website and click on training. But don't take my word for it. Let's take a listen to what my student Josh had to say about my coaching.
You were more focused on like the actual strategy of things as opposed to, pushing a particular stock or trying to like almost trick people into like how they can get rich. I'm also a masterclass student as well. And that's where I really took things to the next level. For anyone who's thinking about joining, is anyone can do this. It's just really like putting in the work and the effort to meet Corey halfway, but he will definitely get you there. I started with about $300,000 portfolio. Initially saw about between 60 and 70,000 within my first 6 weeks, which I was very excited about. So now I'm really, really excited to share that I've grown that $300,000 portfolio to well over 500,000. I'm definitely reaping the rewards now. Don't wait. I honestly can't thank Corey enough.
So you heard what my student Josh had to say. I would love to help you achieve your financial goals, just like I did with my other students and Josh. Just go to the website, InvestWithCorey.com. Link is below. Click on training and then watch the video and book a call with my team and I. I look forward to helping you on your financial journey. So here we are looking at the SPY to give you guys an idea idea of what's actually going on in the market. You guys can see that the SPY has trended upwards considerably over the last few months, but we've had a few pullbacks on the SPY, and the two big pullbacks of the year happened right around the middle of November, and this past week it started to correct and go back up. So there's a 1 week pullback, and then somewhere around the end of October there was another 1 week pullback, and pretty much the same thing the beginning of September until about the middle of September. And then there were some pullbacks in the middle of July until about the middle of August. So we are in a really strong bull run for the SPY. And remember, this is money on the sidelines. So as a whole picture, when we look at this, it's safe to say that we're not really going to pull back much. There might be some. We could see SPY pull back and gap fill to 576, which might seem scary, but considering the SPY was below 525 in May, it's not a really bad ordeal. So it is possible, and not only possible, somewhat likely that the SPY could pull back in the next month and a half going into New Year's back to around 580, maybe 575. And then after the first few weeks of January, it will run back up, break through 600. And in the spring, we'll be up somewhere around here, somewhere between 620 and 640. You see a little bit of a pullback here, January or December going into January, excuse me. It'll kind of consolidate something like this and then start to move up. We could have this kind of movement into February and March, maybe another pullback, and then we start moving our way up like that. That's typically how the SPY moves. See the pattern? Pullback, 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 come up a little, pullback. We're due for a pullback somewhere between now and January. We'll probably close the year out. I mean, it's possible to close the year out at 600, 605, something like that, maybe a little higher, and then pull back and use 600 for support. Or it'll pull back to 580 and use 580 as a support, then break through 600 in the new year. But I don't anticipate, one or the other, I guess you could say, unilaterally. I really fully believe that either or is equally possible. However, when you bring in the psychology factor, that the sentiment really, that there's a lot of money on the sidelines coming into the stock market, trillions of dollars, it's really gonna depend on the Feds. If the Feds announce any more rate cuts or any more timelines for rate cuts that are bullish and dovish between now and January, well, then it's more likely the stock or the ETF is going to go above 600 and then pull back and use 600 as a support and close the year at 600. If we don't hear from the Feds, it's still possible, but less likely. But it's really hard to say. Ultimately, though, it's hard to time the market exactly like this. So what I would say, if you're getting into SPY, I would say buy leap options going out to May or June. If you do that, come May or June, doesn't matter what happens in between. It's all noise. Like, look at this. This is where I anticipate SPY. So does Tom Lee. And this is where we are. So if you enter here, it doesn't matter what happens in between. If it ends up here, you enter there and you could exit over here or continue to hold. So it's irrelevant what happens in between. Personally, you could add some leap options right here. If it pulls back, add more and dollar cost average. It is quite simple to do. You could do this on the SPY easily on Robinhood. You'll just go out to May, right around May 16th or May 30th, and you'll pick a leap option that you want. I think 570 or 580 is good. We look at 580. This is going to give us a 71 delta. And the price on this is 4,500. Now, the delta is 71. That means that every time the stock goes up $1, this is going to go up 71 cents. Right now, the SPY is at 600 or just under 600, 599. So if the SPY goes up $20 by May, 20 times 0.71 means this option would go up $14.20 times 100. So you would gain $1,420 per leap option. So if you got two of these leap options, well, then you would make $2,840 plus any covered calls that you sell. This is a very strong return. And I highly recommend doing leaps on the SPY because you can sell short covered calls against it. Now, if you're with Fidelity, it's just as easy to do this. You'll click on SPY and you will go into SPY and buy leap options similarly to like you did on Robinhood. Right here, you'll click on calls. And this is if you're using their Active Trader Pro. We're going to click on the date we want, which is May 30th. And you can see right now we are trading in the May 30th. Actually, I skipped out of May 30th. There we go. We're in May 30th now. We will buy 580. There we go. May 30th, 580. There we go. See, 4,500. We buy to open. Quantity 2, limit, margin or cash. We'll do margin, preview, and then what it'll do is it'll show me the preview that I'm going to buy both. It's going to be $9,101.30. And then when the market opens, I could fill this order. And if you're doing it on Fidelity, but say you're not an active trader pro, you can go in the trading dashboard and you can click on SPY right here. And then you do the same thing. You click on options chain, maximize this, and then we'll go out and we'll look at May 30th right here, which is a weekly option, not a monthly. I love how this website shows that. And we're going to click on just calls, and we're going to scroll down and look for the 580 option the exact same way. So we're going to scroll down to 580 or up, whichever way you have them organized, no particular order. And here are the calls. Actually, it's November 29th. I don't know why it keeps doing that. Collapse expirations. We're going to go to May 30th. There we go. May 30th on the calls. Perfect. And we will buy a 580. So right here, again, 45.50. Buy at 45.50. Buy to open. Quantity 2. Maybe we could get filled a little bit less on the midpoint of 4,400, $8,800 preview order, and then we can just push this through. So it doesn't matter if you're on Fidelity, the website, or Active Trader Pro, or if you're over on Robinhood. Same thing, exact same thing. This is what I would do. This is the strongest thing you could do for your portfolio is trade the SPY. If the stock or the ETF drops in value, then dollar cost average. If you buy 2 at 4,400, it drops, you buy 2 more at 4,000. Well, then you have 4 contracts with an average cost of 4,300. Dollar cost averaging, just like shares, but cheaper, allowing you to sell covered short calls against the position. The market is doing good. There's a lot of money on the sidelines in SPACs and cash sweep programs. But as the feds become more dovish and push more dovish news and cut the rates and announce rate cuts, and the better PMI manufacturing and services data is at the beginning of December and beginning of January, the more money is going to keep coming over from the sidelines, which is cash sweeping and mutual funds and money markets. That money is going to come over into the stock market, and this bullish run that we're in is not really a bullish run. I mean, it is, but it's not like a temporary thing. Like I said on earnings, this is money consistently coming over, which is why the market is moving so hard, moving in an upward direction, and really hasn't had any slowdowns or pullbacks. It is really the time now to get in. If you see any dips, buy the dip dollar cost average, because if this continues, the market's going to be a lot higher next year than it is right now. Don't forget, guys, if you're having trouble in the market and you want to learn and grow your portfolio, I would love to help you, fam. You guys can sign up at investwithcorey.com. Links in the information box below. Click on training, watch the video, and book an appointment with my team and I so I can help you achieve your financial goals. We'll see you guys in the next video. Happy Thanksgiving. We'll catch you on the next one. Take care, fam.